and tackle that universal dilemma literally every entrepreneur faces: figuring out how to get the capital to turn a napkin idea into a living, breathing reality, preferably without losing your mind on the process. Whether you're sketching out some revolutionary software platform or you're planning a brand new neighborhood cafe, the truth is you need money before you can start making money. I want you to picture this for a second. Every great business out there, from the tiny mom and pop shops operating out of a dusty garage to massive global corporate giants, eventually hits a wall where their grand vision just completely outgrows their bank balance. It's the ultimate bottleneck. Without that financial fuel, even the most mind-blowing, world-changing ideas are just going to stay stuck on the drawing board. So, where do founders actually find the cash to bridge that gap? Well, here's our roadmap for today. First, we'll look at the universal funding bottleneck. Then, debt versus equity. After that, we're exploring alternative funding, what angel investors actually want, the bulletproof business plan, and finally, avoiding the dreaded no. Okay, let's jump right into part one: the universal funding bottleneck. Look, financing isn't just about scraping together the cash for launch day. It's the critical engine required to operate day to day and actually expand year over year. Think about it. You can't run a bakery without buying ovens, right? You can't scale a tech startup without hiring brilliant coders. Business financing is the mechanism that lets you buy equipment, purchase inventory, market your products, and frankly, just keep the lights on. It's literally the bridge between what your business is right now and what it has the potential to become. Moving right along to part two: debt versus equity. This represents the classic cost versus control dilemma. On one side, we have debt financing. Think of a traditional bank loan. You keep 100% control of your company, and you have highly predictable monthly payments. But the major downside is the strict rigidity of that repayment. The bank expects its money with interest every single month, even if you have a terrible month of sales. Now, on the other side, you've got equity financing. This is where you give up partial ownership and some decision-making power to an investor. The massive upside here: there are absolutely no monthly loan payments choking your early cash flow. You're essentially trading a slice of your pie for cash and, ideally, their expert guidance. This really all boils down to your own personal risk tolerance. If you've got a mature business with steady, predictable revenue, taking on debt might be totally fine because you can handle that financial risk without giving up any control. But if you're a fast-moving startup prioritizing hypergrowth, you might desperately need cash today without the heavy burden of monthly payments. So you got to ask yourself, are you going to keep 100% of a small pie or give away a slice to help bake a massive one? All right, let's pivot to part three: exploring alternative funding. So many people go online searching for free government money, but the reality is that pure federal cash just for general business operations is incredibly rare. However, if we break down the funding into tiers, there are actually some amazing opportunities out there. At Tier 1, the SBA does run specific federal initiatives, like they recently had a $50 million pool just for manufacturing workforce training. But Tier 2, that's where the real volume lives: state programs. And Tier 3, private and corporate grants, well, that's often the fastest path for most founders. You've got highly viable options like the Galaxy Grant at around $2,700, the US Chamber offering 10 grand, and the Amber Grant providing up to $30,000 a year for women-owned businesses. Speaking of those Tier 2 state programs, check out this staggering metric. The State Small Business Credit Initiative, or SSBCI, basically pushes federal money down to the states so they can design their own localized capital programs. And the U.S. Treasury expects these funds to unlock up to $10 of private investment for every single federal dollar allocated. 10 to 1. That means billions of dollars are actively flowing into local state economies right now to support small businesses. And just look at the sheer explosion of equity crowdfunding. Back in 2010, this was just a tiny little niche with a modest $1.9 million invested. But fast forward to 2021, it ballooned to over $1 billion, and it stayed massive with over $558 million invested in 2024 alone. Crowdfunding is such a fascinating middle ground. It lets you raise capital from a huge pool of regular individuals without taking on scary bank debt, and it simultaneously validates your market demand. I mean, you're literally proving people want your product before you even fully launch the thing. Brilliant. Now, beyond grants and crowdfunding, a whole host of alternative debt vehicles have stepped in to fill the gaps left by traditional banks. You've got unsecured loans that base their decisions on alternative data, like your transaction history, rather than hard collateral. Or think about merchant cash advances. These are tied directly to your point-of-sale terminal, where you just pay back a small portion of your daily credit card sales. There's invoice discounting, which lets you borrow against unpaid invoices from those big corporate clients who take forever to pay, plus equipment finance to lease to own necessary machinery. And finally, there's even a clever strategy called ROBS, which allows you to roll over your 401k or IRA retirement funds to finance your startup without actually taking on debt. Let's shift gears to part 4, what angel investors works. We call this the founder factor. Angel investors are not just buying into a cool product. They are heavily investing in the people behind it. You can honestly have the most innovative solution in the world, but if you don't have the technical expertise, the business acumen, and the sheer grit to execute it, an investor's going to pass. Often, these investors are former entrepreneurs themselves, so they're looking for founders they can step in and mentor, sharing their valuable industry connections to really accelerate your growth. So what's the ultimate angel investor checklist? Well, they definitely want that proven team. They want a unique value proposition that actually solves a real pain point for people. They absolutely need to see a sizable market potential that proves the business can scale up. But here is a massive warning. You must have a justifiable, realistic valuation. Bringing a wildly inflated valuation to a pitch is a huge red flag. It instantly signals to the investor that the founder simply doesn't grasp their own numbers. And finally, they want a clear exit strategy. Because, eventually they do want a return on that investment. Next up, part 5, the bulletproof business plan. To prove to anyone that your business is financially viable and a safe bet, you absolutely need a bulletproof business plan. It starts with a crisp, compelling executive summary. From there, you have to prove you know your market and your competitors inside and out, while detailing your exact pricing mechanics and your sales strategy. But most importantly, you need rigorous financial forecasts, your cash flow, your exact funding requirements, your repayment plans, and exactly how you plan to mitigate the inevitable risks. You have to show them you've thought about what happens when things go wrong. Let's just pause on this thought for a second. Financing should support your growth, not create unnecessary financial pressure that ends up sinking your business. Securing capital isn't just about grabbing cash from wherever you can find it. It's about choosing the right source at the exact right time. It's a pretty sobering reality that taking on the wrong type of debt at the wrong time can completely overwhelm your cash flow and sink a company that otherwise had incredible potential. And that brings us to our final section, part 6, avoiding the no. So, why do lenders actually say no? Well, lack of collateral is super common, as traditional banks view small enterprises as high risk. Unresolved litigation is an obvious red flag, as is simply coming across as apathetic and unprepared during your pitch. But interestingly, and a lot of people don't know this, lenders will often reject businesses for asking for too little money. Crazy, right? But it's true because the administrative cost of servicing tiny loans just isn't profitable for conventional financial institutions to underwrite. To firmly ground your expectations here, if you want traditional financing, the magic range is a credit score of 690 to 850. That's the ideal sweet spot traditional lenders are looking for to comfortably approve your application. They really just want to know your history of handling debt is rock solid before they start handing over their depositors' money. Before you sign on any dotted line and take a single dollar of debt, you must rigorously answer 3 questions. 1, how is this money actually going to generate a return on investment? 2, can your current and projected cash flow realistically handle the repayment schedule? And 3, the absolute most important one, what is your contingency plan if your sales are lower than expected? Because if you can't answer those, you are basically flying blind, and the risk is just way too high. Innovation is absolutely fantastic, but it is effectively meaningless without a solid financial strategy to actually bring it to life. Business financing is the fuel that powers growth. So, as you look at your own numbers and your own risk tolerance today, it leaves us with one pretty sobering question to ponder. How many world-changing, revolutionary ideas have we already missed out on simply because the visionary couldn't secure the right funding? Something to think about.